Hey everyone! Welcome back to Your Money Your Way. In this video, we're diving deep into a company that's undergoing a massive transformation. Imagine a household name, a giant in the retail world, deciding to flip its entire playbook. We're talking selling off major parts of its empire and betting big on a leaner, meaner strategy. Is this a stroke of genius that could unlock huge value, or a risky gamble in a tough market? Stick around, because we're about to unpack it all. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Alright, the company we're putting under the microscope today is DFI Retail Group. You might know them from brands like 7-Eleven, Guardian, Mannings, cold storage, or IKEA in various parts of Asia. This isn't just a minor tweak we're talking about. DFI is in the middle of a full-blown strategic overhaul. They're saying goodbye to some familiar businesses and doubling down on what they believe are their golden geese. Let's get into it. So, what exactly is DFI doing? Think of it like a massive decluttering. They've been strategically selling off businesses that were either underperforming or didn't quite fit their new, sharper vision. For instance, they've divested their stake in Yonghui superstores in China. They've also sold the Hero supermarket business in Indonesia. And more recently, in a significant move, they parted ways with their cold storage and giant supermarket chains in Singapore. Why all this selling, you ask? It's all about focus. DFI is channeling its energy and resources into two main areas they believe will drive the lion's share of future growth. First, health and beauty. Think of your local Guardian pharmacies and Mannings stores. Second, their convenience segment, which is primarily the ever-present 7-Eleven. These are generally seen as higher-margin businesses with stronger growth potential in the current retail landscape. Now, you might think selling off big chunks of your business would hammer your financials. And yes, their overall reported revenue did see a slight dip, down about 3% in 2024 to roughly $8.9 billion. But here's the kicker, and this is important. Their underlying profit actually jumped by a very healthy 30% in 2024, hitting $201 million. This suggests that the businesses they're holding on to are more profitable, and they're getting a better grip on costs. Even better, by February 2025, DFI announced they had achieved a net cash position. That means they have more cash on hand than debt, a really strong and flexible financial position for any company. Okay, so they're leaner, but are they poised to be meaner in the market? Let's look at the positives, the green flags, if you will. First up, those core segments, health and beauty and convenience, are indeed looking pretty robust. Guardian in Southeast Asia has been demonstrating strong profit growth, and Mannings in Hong Kong has been gaining market share. The convenience stores, like 7-Eleven, are benefiting from a better product mix, especially with more high-margin items like ready-to-eat meals. And early indicators from their Indonesian subsidiary for the first quarter of 2025 also showed Guardian performing very well there, with double-digit like-for-like sales and profit growth. Second, DFI isn't just cutting back, they're also looking to innovate. A great example is their recently announced strategic partnership with Dingdong, a major fresh food e-commerce player in China. The plan is to leverage Dingdong's advanced supply chain capabilities and technology, including AI for inventory prediction, to offer a wider and fresher range of products in welcome supermarkets in Hong Kong. This is a smart, modern approach to boosting their food segment where it makes strategic sense. Third, that financial strength we just talked about, being in a net cash position, is a huge plus. It gives them significant flexibility for future investments, perhaps even for smart, targeted acquisitions in their core health and beauty and convenience areas. Plus, it underpins their ability to return cash to shareholders. On that note, they increased their dividend for 2024. Fourth, the folks who analyze stocks for a living, the analysts, are generally warming up to DFI's story. Management is guiding for underlying profit to be in the range of $230 million to $270 million for 2025, which represents a potential 14% to 34% year-on-year growth. Analysts at firms like RHB Investment Bank and UOB Kay Hian have buy ratings on the stock, pointing towards an earnings recovery and what they see as an attractive valuation compared to its regional peers. Some analysts highlight that DFI might be trading at a discount while offering a competitive dividend yield. And finally, in today's world, this is increasingly important. DFI is also making clear commitments and progress in sustainability, focusing on initiatives like reducing emissions and waste. This is not just good for the planet. It's often a sign of a well-managed company looking to the long term. But, as with any stock, it's not all sunshine and rainbows. Every investment carries risks, so let's put on our cautious hats and look at the potential hurdles for DFI Retail Group. The biggest one that often comes with major strategic shifts is execution risk. They have a new strategy, and it sounds promising on paper, but the challenge is always in the execution. Can they consistently pull it off across all their diverse markets? Big transformations are complex and can take time to fully bear fruit. Then there are the segments that are still facing some headwinds. Their home furnishings business, which includes IKEA in some regions, has been struggling with weaker customer traffic, particularly with softer property markets impacting demand. While they are working on cost control measures here, it remains a challenging area. The retail world, as you know, is fiercely competitive. DFI faces constant pressure from other established players and nimble new entrants, including those leveraging advanced technology and innovative business models. Plus, external economic factors like rising food costs and general inflation can squeeze consumer spending. This might lead to behavioral shifts, like consumers in Hong Kong looking for cheaper deals across the border, which could impact DFI's sales. And while that underlying profit growth is impressive, the headline revenue growth is still projected to be quite modest. Management themselves guided for about 2% organic revenue growth in 2025. The market will be keenly watching to see if this can accelerate or if the company can continue to drive high-quality profit growth even with slower top-line expansion. Some analyst forecasts project very high earnings growth rates, which might be a bit on the optimistic side or influenced by a low base effect. So it's always good to weigh these against management's own, perhaps more grounded, guidance. So, what's the verdict on DFI Retail Group? This is a classic transformation story in progress. They're strategically shedding old skin, sharpening their focus on their core strengths, and building a much healthier financial foundation. The potential is certainly there for a leaner, more profitable, and more agile company that could reward patient investors. However, the path of transformation is rarely a straight line. Execution remains key. Some of their business segments continue to face challenges, and the competitive and economic landscape is always dynamic and demanding. Now, for the really important bit. I am not a financial advisor, and this video is not financial advice. It's purely for informational and entertainment purposes. Always do your own thorough research and consider consulting with a qualified financial professional before making any investment decisions. Investing in stocks involves risk, and you could lose money. So, what do you think about DFI Retail Group's big makeover? Is this a company you're watching? Do you see more upside potential, or are the risks too significant for your liking? I'd genuinely love to hear your perspective, so please drop your thoughts in the comments section below. If you found this deep dive insightful, please give this video a thumbs up, it really helps the channel. And don't forget to subscribe and hit that notification bell so you don't miss out on our next stock analysis. Thanks so much for watching, and I'll see you in the next video.